Right, hello everybody. Welcome to today's session. This is Adrian Buthee here, and I'm the head of trading here at Trendsignal. And today, we're going to take a few minutes, half an hour maybe, and we're going to go through the latest trading opportunities for the Forex and the stock market. So we're going to talk about the trades that are setting up maybe over the last couple of days, but certainly the trades that are set up for today or tonight. So we can have a look at those in a bit of detail, what we like, what we don't like, where we think they might go to, that sort of thing. Just to, I guess, some of you that may not be Trendsignal members yet, you may not have enrolled on one of our courses or using one of our systems, just gives you a real good idea about the day-to-day routines, the acts that we follow in order to identify our trades and then go on to place those trades as well. So look, we are live. I am talking right now on this 13th of December. It's freezing, isn't it? But the thing about doing it live means that you can interact, you can get involved, you can ask questions, and you can respond to the questions that I ask you. So can you all give that a go for me now? Now, I know some of you out there might be watching us as we're being streamed on YouTube or various other places. But if you're on GoToWebinar, I'll be able to monitor that chat really easily. So just type something in. If you're not too sure what to do on the GoToWebinar program, it looks something like this if you're on a smartphone or a tablet with the questions mark at the bottom there. Hit that and then allow you to type in the way that it does. Or if you're on a laptop, desktop computer, on the right hand side of your screen, you'll see the little button here with a question mark there. Also the bubble, speech bubble, and then you can type in here. So if everyone can do that for me, just type hello or something into the questions box. That would be fantastic. And then we can get started. Oh, Carl, Michael, Mark, Fatha, Damien, Gogo, Jonathan, Margaret. Good. Let's get started. Before I do, however, there is a risk notice that I do need to cover off on. Don't panic, I'm not going to read all of this. But spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. This presentation has been prepared without regard of your financial objectives or financial situation. All opinions, news, research, analyses, prices, other information herein are intended as general information and are provided on the understanding that Trendsignal is not rendering investment, legal, or tax advice. Okay. Whew, good. We can get on now. So what I'm going to do is take you through the opportunities. We're going to go straight to the charts. This will absolutely not be death by PowerPoint. So I want to talk about what's happening and what's happened over the last couple of days. Okay, so I do have a set agenda. If you do have any questions to go through though today, if you're not too sure about what's happening this week, it's a big economic data this week. There's an awful lot going on. You can ask questions about that and we can go a little bit off plan if you want to. To be honest though, today I'm not really going to be focusing on that. I just want to focus on what the charts are telling us and then what we might look to do with it. Okay. So look, what I've done is, or what I'll do is I'll run a scan for trading opportunities for the D1 sniper strategy. This is trading off the daily chart for the last 3 days. We'll hit that search. And what that does is it tells me the trades from today, yesterday, and then the day before that, basically. So, and the look back then tells me those responses. So what I have there with the number ones is that these are trades that are setting up today, and the threes were the trades setting up. Number 2 would be yesterday. Number 3 would be the day before yesterday, which is in this case Friday. So we'll have a look at the ones in a second. I just want to take you through the threes from a couple of days ago. They're all either invalid trades or they're already out. So we're going to go through those and then we'll talk about the new trades as well. I think by that time we'll have a bit of an understanding about what we're looking at as well. So to begin with, I've got the Australian dollar against the Japanese yen. Like I said, this is a daily chart. Now I'm going to assume you know a little bit about the strategies. I'm not going to go into a great deal of detail about it, but what we can do is have a look at the opportunity there. So the thing about sniper trades is that, the marker is kind of obvious. If you've got one of these discs on the chart, it's basically saying sharpen your pencil. There's a potential opportunity setting up. Now, there are a couple of other things that we check off on, such as minimum stop loss distances and a couple of other things that can help us to get a smoother result on our trades. But for all intents and purposes, to coin that horrible phrase, this is a buying opportunity. So green outline for a buy, red outline for a sell or a short trade there. So what this does is on that day, on Friday, they gave us a buying opportunity on the close of that particular candlestick. And that's all pretty straightforward, right? The question is, or the point I guess for today is what else was going on? What made this a buy? And what else could we perhaps glean out of that? Is there any other sort of concepts we could look at this chart that made it sort of, a bit more interesting than perhaps just what the system actually identified? So first of all, let's think about what the system has done in order to, or looked at in order to identify this as a trade. Probably take a step back a second. What do we as a system provider or the system authors have done is we've looked at this instrument and many others to look at these turning points whenever the market changes color. So price goes from a red line here to a green line. That tells us about a change in the direction of price. What our system will then do is analyze what's happening at that time, so the context of that turn. So is that a rotation higher in an uptrend, or is it in a downtrend? Have we got a ascending chart patterns or descending chart patterns and so on? We need to be analyzing all of these different things in order to determine whether something is more likely to rise or more likely to fall. Now, where over the past 11, 12 years there is a statistical advantage in a particular opportunity, their disk will pop up on the chart. Where there is no statistical advantage or the results are just far too erratic for any sort of smooth outcome, the turning point will not have a sniper disk. Okay, so for example, you'll notice this turning point here, there's no disk in this place. Okay, why? Because all opportunities that look like this, technically, when the market changes price direction, are not particularly great trades. Some of them are, but some of them are not. And it's about having, where do we have a more consistent result with our trades? The opportunities that demonstrate a more consistent result have one of these discs on the chart. Okay, now we have one here as the market changed direction from red to green here. Close of that bar, we had a sniper trading opportunity locked in. Now, why was that? What was happening at the time? Well, this was a buy in line with the ascending monthly trend. So we take a look and see what's happening on the monthly chart, and the chart pattern is rising as well. So we're seeing suddenly now a situation where, well, look, we've got a high here, we've got a low here. This is a higher low. Higher high, this compared to there, that's a higher low and so on. That's a higher high, higher low. You're starting to see the market start to ratchet like this, which is kind of positive too. So, crudely speaking, you're seeing a market that's in a strong uptrend that is also showing positive chart patterns as well. So those things are positive, and that combination of a market being very oversold also is a pattern that has historically produced extremely good trades. So therefore, the system has identified this as a sniper trading opportunity to put that very clear marker on the chart. Okay, now just very quickly, does this all make sense, everybody, so far? Just give me a quick yes or a no in the questions box there, just to make sure we're all okay so far. That'd be great. Okay, so there was a buy Friday night. The question is, what do we then do with it? Is there any other context to this trade? Now, we don't necessarily have to do this, but one of the things I like to do is I like to look at the situation itself. What a system can't do is start to look at other factors like support and resistance and so on. It's really hard to have a system that can look at those sorts of things because they're a little bit more subjective now. So when you have a system, it really needs to be down to hard, fast rules. It's very black and white. It's a bit like, well, what can a computer program? Can it be that specific? When you look at things like support and resistance levels, it's actually a little bit more tricky. What we can see certainly is, well, this market has gone down to here, which was support level from back here. The market spiked from that level in mid-October, and then we bounced off that level again. So that's kind of cool. So kind of, what you're looking for is reasons to support that decision. Now, what you're not doing is being blinded by that and thinking, okay, I've got a buying opportunity. I should only look for positives now just to reinforce my position. That's sort of confirmation bias. But what you're looking for is, okay, well, is there anything here that tells me that this opportunity is perhaps more likely to be a winning trade? Well, the fact that we've bounced off that support level, and let's assume that support and resistance is a positive for our trading, then that's got to be a good thing, right? So what we could also do is even look a little bit further. We could look back and say, well, okay, what happened the prior time we hit this level back in, and that was in August, right? So we could have a look at back at August. We could even have a little bit look further back to there if we wanted to, and you can see again that similar sort of level here also. So what you've got is a market that has continually found that sort of 91.50 level, bounced off it once, twice, three times, 4 times there. Okay, so it's that building of that picture that we can do that can help us to sort of add to our trade confidence, really. Now, this isn't something that all traders have to do, but I think from my perspective, I like to, you start off on the simple way of doing things, and then you can start to add in extra elements. So I was trying to think of different ways of sort of describing this. In a way, if you think about, the if you think about perhaps the speed limit on a road, it might be 70 miles an hour, but would you still drive 70 miles an hour in the snow? Whilst it had ice on the road, whilst it was really greasy, whilst it was really dark, you probably wouldn't. Whilst it was really busy, no, you probably wouldn't. So whilst the limit might be 70 miles an hour, actually our results and our outcome can actually be improved by looking at a few other concepts where we're less likely to then crash the car. And it's a similar sort of thing. So are there other factors that we can look at on the chart in addition to the snipers that could give me greater trade confidence? Well, hopefully we've gone through an example of what that might look like. In terms of this particular opportunity, we can use this tool TradeMate, where we provide these starter targets that we can add on. Now you can choose to go with extended targets. Now what these are statistical levels where, again, based on not looking at this individual opportunity, it's looking at generally speaking, any opportunity that looks like this for this particular market moves about this far. That's basically what this is saying. And that has historically produced a really good statistical positive outcome. Now you can go for a slightly bigger target with the extended ones, because it might be that it looks to go a little bit further, but then you might want to just monitor that a little bit more closely, or indeed you can customize it based on what you think for the individual opportunity itself. And again, this is moving from really a system follower to somebody who is a little bit more involved in it and actually wants to sort of add a little bit to it. It's a little bit like when you first start to learn to drive, you'll learn to drive in the way in which your instructor teaches you, but actually then you'll start to add in the sort of the experience element will start to sort of take over as well. Either way, for this particular opportunity, it was looking for a target up to 93.28.9, which is effectively just under where the market's been. It's got to 93.34 today. So actually a really nice trade. What's that, about 50 pips or so? Really nice profit opportunity on Australian dollar against the yen, which is the output here. The take profit level is really the most likely scenario for this particular opportunity. Okay, so without using all that extra discretion and so on, we can go for that. As far as a sort of a bigger target there, really you're looking for where the market finds congestion. Okay, so if you wanted to go, this is one of the benefits of actually a system like this, is that when you look at a chart, it's like, okay, so I'm going to buy it, but where could it go? It's like this big question mark here. You could look at the sort of the recent spike here. You could look at the congestion that's happened here, where there's been sort of a real lack of sort of follow through. The market's probably going to stall just below $94. Sorry, 94 Australian dollars to the yen. Yen to the Australian dollar, in fact, isn't it? But the point is, we don't necessarily have to think about that in the first case as Trendsignal members, because we have that information on that TradeMate tool. Okay, Damien, will TradeMate produce the same figures whether you check on Friday or now? So what the system will do is it'll look at the situation for the bar. So if you looked at this on Friday and if you looked at this now, the output here should be the same. That said, Damien, the take profit level is relative to the entry point. So it's about a distance. So what we're looking for is, let's say, 50 points or 60 points, 100 points, 300 points, whatever, from the entry point. So if you're looking at this before the market closes on a Friday, let's say, for example, that what do we got here? You look at it at 6 o'clock in the afternoon, and it's trading at 97.50. Okay, so 90, sorry, 90, what was it? 92.50. Okay, and then it closes at 92, whatever it was, 78. When you look at the trade mate level, that's based on where the price is now. But if you're looking during the day and it's only at 92.50, and that was at, say, 6 p.m., well, the day doesn't really finish till 10 p.m. So what this means is that the trade mate level is going to be referenced against the 92.50 if you look at it at 6 p.m. But if you look at it at 10 p.m., it's going to be referenced against whatever the price actually is for that day. So when that closes at 92.78, then the target will be referenced against the 92.78, which is the closing price for the candlestick, which is when the trading opportunity is locked in and confirmed. As end of day traders, the opportunity isn't really locked in until the end of that day. So as long as it's after the close, then those levels are locked and will not change thereafter. Does that make sense, Damien? So really, like I said, once you, like the same thing with this candlestick here. During the day, as the price was falling, the target, if you looked at it earlier on in the day, the target would be a little bit different. But as soon as you got to the close, which is the time point for the trade, then it is set and it's locked in. All right. Hopefully that makes decent sense. Okay, so that's Aussie yen. Hopefully that provides a little bit of clarity. What I wanted to go through, and actually the main reason for looking at the sort of the previous trades or so, is actually to have a look at what's happening here with euro against the Swiss franc. It's an interesting trading opportunity, which didn't really go that far, and I want to just bring it up on TradeMate here. As a trading opportunity, it kind of looks okay, but one of the things I wanted to bring up was that sometimes there are snipers where we don't necessarily want to take the trade. This is actually an example of that, and that's because the stop is just 28 points. And why is that a problem? In our experience, and this is backed up statistically, but it also makes sense sort of fundamentally, I suppose, is that if your stop loss is too tight, too narrow, in our experience, you're much more likely to have a loss-making trade. So there is a sweet spot in our data analysis of however many thousand trades or opportunities of about 40 points. If the stop loss from this system is less than 40 points, in all likelihood is that it's more likely to be a loss-making trade. So what traders will naturally be gravitating towards trades with the tighter stops, but actually if the stop is too narrow, it actually becomes more likely to be a loss. It can go that sort of the other way. So does anyone know why that might be the case? So why could it be that if your stop loss is too tight, that we might not want to take that trade? It's perhaps more likely to be a loss-making trade. Because after all, let me know in the questions box, please. I'll be interested to know your answers. Now, it might well be that, we've got a descending candlestick and chart pattern. We've got a descending monthly trend. We've got the overbought market here. This is actually really just the flip opposite of the Australian dollar against the yen trade. So that was a buy in line with an ascending chart pattern and an ascending monthly trend. The market was oversold and so on. This is the mirror image of that. The question is, why would too tight a stop loss be a problem? Okay. Any ideas? Gogo saying it's true. The problem is that there's sort of two things with it really. Number one is that your trade needs a little bit of room. Okay, there is a natural amount of sort of, I guess, random oscillation that takes place in the marketplace. So you can have uptrends, but within an uptrend, you're going to have the market sort of moving up. So you could say that's, broadly speaking, that's going up, but it hasn't half gone flying around over that period as well, hasn't it? It's going to chop around a little bit. So what you'll find is if your stop loss is too narrow, you could still call the trade right, but you can get stopped out on it being sort of whipsawed around. So if you don't allow what you have around any turning point is a natural conflict between buyers and sellers, right? So you have to allow that conflict to run its course. So as that conflict takes place, you see, if the market's in a strong trend either way, then really there is no conflict. The buyers are just prepared to pay higher prices and the sellers are prepared to sell at lower prices. But once it makes its highs and its lows, that conflict then starts to increase. It's like, who's going to win this battle? Suddenly sellers start to think, prices rise, and sellers think, oh, actually, that's quite a good level here. So you end up that sort of tug of war, if you like, between buyers and sellers, which creates that sort of increase in volatility around any turning point. And what you need to do is allow that turning point to take place and to run its course. If your stop loss is too narrow, you can get chopped up within that sort of natural movement, the sort of movement that we should actually expect. So again, that sweet spot tends to be around that sort of 40 point sort of level. So anything where the stop loss is less than 40 points really is a bit of a red flag. Maybe you want to take a bit of an extra analysis on it. Maybe you want to widen the stop on a little bit if you fancy it. But it just needs a little bit of extra sort of thinking. Okay. The other thing is that the other thing with it is that very often, I mean, this is not a bad entry candlestick, actually, to be fair. But if I was to show you one on, let's say, there was one on dollar yen, I think, just a couple of days ago. I think this is an interesting example. So if I take this here, I've got a potential selling opportunity here. So I've got the sell sniper on the D1 accelerator strategy. And, I can see here that I've got this bar here. I've got the stops about 20 points or so away, something like that. So it's quite narrow. We wouldn't be interested in it. But why is that a problem? What you have to do is think about who's actually winning that candlestick. So what you have there is a bar that's like this and like that. Okay. So who do we think is winning that candlestick? Do we think the buyers are winning that candlestick? It's actually down. It's a down bar. It's a down day. But who's winning that candlestick? All the buyers or the sellers? You can put B or S, hopefully not meaning something else. But type B or S. Who do you think is actually winning that candlestick there? The buyers driving prices higher or the sellers driving prices lower? Type B or S into the questions box, please. Let me know what you think. So Gogo's saying the sellers are winning that particular battle. Mark is saying the buyers. Let me know, everybody. Try and get those responses in as quickly as possible if you can. Get involved. Fatha is saying, hopefully I'm pronouncing your name right. I think it might be Fatha. Kipling, sellers. Okay, so we are literally 50-50 at this point. So a lot of you just hiding and not saying anything. Okay. Let's think about how that candle has actually evolved. Definitely a few more buyers coming through here. So there's the open at the top of the real body. Okay, so there's your open, there's your close, there's your high, and there's your low. So how do you think this day might have actually panned out? Well, it's important to have a quick look at this because, we'll have started here in all likelihood. We probably went up here. Then we probably went all the way down here, and then we went all the way up here to our close. That's the most likely scenario for the day, just from looking at that particular candlestick. So what does that tell us? It tells us as the day finished, it was being driven higher by buyers. It's a little bit like the sellers gave it a bloody good go, actually, but there weren't enough sellers down there. In fact, all it was met with was a big wall of buyers down at those levels thinking, yeah, I'll have some of that and I'll buy some of that. Thanks very much. Absolutely. So actually, as the day concluded, it was buying pressure that drove this move home. So whilst you ended up with a sell opportunity, and the reason for that is because statistically it still looks pretty good. You still got the right type of technical patterns and so on. Objectively, you'd look at this and think, well, because the stop loss is so narrow, is just not enough room for it. You're just going to get chopped out on this opportunity anyway. And B, look at that entry bar. I'm not such a big candlestick fan anyway. It's not like I'm all about the candlesticks. But ultimately, you're looking at selling a market that is actually going the other way. For me, I like to trade downstream, as it were. So if I'm going to buy a market, I want to buy a market that is rising. I like a good strong entry candlestick. If I'm going to short a market, I want to know that it is falling. Actually, what I'm doing here is I'm shorting a market that's actually rising into the close. So the buyers are in control of a market that I'm about to short. Doesn't really sound that great to me. And actually, one of the things you'll notice with that is because if that happens, you see a particularly rogue candlestick like that, then actually it means that the stop loss is naturally going to be tighter, because it means that, if I was all the way down here, you'd have a wider stop. Now that it's up here, the stop's going to be tighter on a short trade, right? So actually, if I'm going against the current, as it were, I'm more naturally going to have a tighter stop, and therefore more likely to have a loss-making trade as well. So it's quite an interesting thing. Again, everyone, does that make sense? So it is that little bit of context that can help do that. One of the reasons we put this note in on that TradeMate tool is to actually tell you. So if it's less than 40 points, we'll tell you. So it's a bit of a warning to say, oh, okay, have a look at it. And that's something that we wouldn't recommend taking on that basis. As you become more experienced, you can make a choice and you can decide to go for wider stop and so on. But from the first entry level perspective, we recommend not doing so, simply because they are lower probability trading opportunities, and therefore, it's more likely to be a loss by definition. Is the D1 Sniper an end of day trade? Yes, it is. And how long are you going to trade for? Anything between a day and 7 days, really, Salik, something like that. Okay. Damon, you're right. The candlestick could have gone back the other way. I'm just not convinced, really. But we don't know. All we can do with so what Damien is saying is that candlestick there, it could have gone like that, or it could have gone like that, couldn't it? And even pulled back. Either way, it's rejected all of this movement down here. That's really the point. You've had that massive rejection of the downside that tells you actually the prices have then come into the close and stayed up here, relatively speaking. So either way, it's not particularly positive. Does it make sense still, everybody? You still with me? Give us a quick yes or no. Let me know you're still awake. If nothing else, that'd be cool. So look, let's have a look then at the Nikkei. Interesting, a couple of opportunities there, some interesting trades and so on. Wide enough stop loss, so it wasn't a red flag trade. The stop loss was about 100 points. It's ended up being a nice trade anyway, so it's pretty cool. So let's have a look at the latest opportunities. So there are a couple. The reason I'm bringing up today is because there are a couple that are in that sort of filter sort of mode at this point. Euro, Aussie, Swiss here, that's setting up for tonight. It's a pretty ugly looking tight range, and the way I'd view about this is A, it's a tight stop, and B, narrow range. Do we expect this market to break out? It's stuck between here and here. Really up to that sort of 64 double O's level is about all it's really good for. It really is. It's just banging between these levels. It's a pretty grim looking chart actually as it goes at the moment. In terms of stop loss at this stage, it's about a 20-point stop. I suspect this will not be a valid trade when it comes through, but we'll see. We'll have to keep an eye on it as we come through over the next few hours. I don't particularly like it. It won't be a valid trade because the stop loss will be too narrow, and therefore by definition more likely to be a loss-making trade. Not enough room to breathe, as it were. And actually, I don't mind it because actually I think this market is massively indecisive. Sometimes you look at a chart and you just think, I just want to trade it where it's nice and free flowing. This is actually relatively ugly. Let's have a look then at Euro Sterling, which is another opportunity. A little bit more free flowing on the Dow. So, sorry, that's Euro Sterling, sorry. You do also have a tight stop, but again, it's a little bit choppy. Sorry, I thought it's the Dow I like. It's not this one. This is not so clever again. Really tight range. This market sort of needs to break out a little bit, really, if anything. But again, one of the things you'll notice on this one. Let me just get rid of those script. Ooh, that's the wrong thing. What's the distance between here and here for the stop loss? Again, let's bring it up on TradeMate. Sometimes, these things are the trade police. They are designed to help us to avoid riskier trades. The stop at this stage is only 33 points. And again, that's giving us a little element to say, just be a little bit careful with it. Maybe not take it, particularly if you're new to trading, or particularly if there isn't any additional context to the opportunity. Now, I know you might be saying, well, this is, a little bit of extra stuff I didn't, necessarily need to think about. You don't have to. That this is all taught. You should avoid it. However, the next stage is, well, on what basis could I take it? Maybe I still want to take it. I don't know. And that's something that you can start to develop those skills in a second. What I would say about this particular trade, however, is it's kind of similar to that Aussie yen chart from before, in that we're shorting into a pretty reasonable support level. If you look at where we are right now, there, look at the wicks. Okay, we're struggling to go below this level, and even here. So the number of times this market is banging into this level and we want to short into it. Good news is the stop's wrong anyway, so we're not going to be taking it in any case. But what you are is looking to sell it right on a particular level of support. So actually, while statistically this might be a solid enough example, actually, contextually, if you add in that extra element of sort of subjectivity to it, this would be a riskier play. Now, it might absolutely puke from here, and it might end up falling for the next 3 weeks, and you might be sitting there thinking, bloody hell, Adrian, what the hell do you know? Well, we'll find out, won't we? But the point is, on balance, there are factors to suggest that this is a riskier play. There are, in golf terms, there are par fours which have just got nice super wide fairways and just nice and easy. You can slash a driver down there. There are others that have got bunkers out of bounds and water hazards all over the place. This is a little bit more like that. So it's just about understanding some of those extra elements. You don't have to understand those, by the way. The rules-based approach is absolutely fine, but it is an area from which we can then look to build. Okay. Again, just adding in some of those elements, the context elements, doesn't half make it a whole lot more interesting as well, than rather than just following a disk on a chart too. Okay, so for me, at this point, I'm not interested in those. What is interesting about this particular trade is that, I'm not against shorting euro against the Australian, euro against the pound. But what I would really like is to see us closing down at these sorts of levels. And I'd like that not just because that means the stop loss is going to be a bit wider, but if I can get a good low convincing close and demonstrate that actually price is going to close below all of this support and violate that support, then do you know what? That's really going to tell me that this price is more likely to drive lower. So it's about whether it's going to break through this level or not. And if it can break through it by the end of today, then actually I'm going to be quite keen and quite interested in taking this opportunity, because once you break through support, then actually it can be sort of a free fall that happens from then, a nice, smooth, straight in one line kind of a move. But we need to get to that point first. So we need to have a nice close below this. It's always a bit of an interesting one, sort of below this 85.50 level. I always find it interesting because what I'm really saying is that I would prefer to sell this market or short this market at lower prices. Now, ordinarily, a trader would prefer to buy a market at lower prices, right? But actually, a trader, you want to be looking at the market moving in the direction you want it to go, because, from an investor's perspective, time is on your side when you're an investor, so you can just stay in it for 3 years or whatever, and hopefully it'll come back. So you're looking at picking up value. With trading, you're not. It's not about value. It's about direction. It's about momentum. So what you're looking for is a market. It's a different style, really. So what you're looking for is the market to be already traveling in the way in which you want it to go, and then you're looking for obstacles that might get in the way of that travel. So in which case, there is a support level about 85.60. So if we can close down 85.50 or so today, then, and again, that's going to be what, sort of half 9, 10 o'clock tonight, then I'm going to be quite keen and quite interested in taking this as a short trade, because apart from anything else, I do have here a market that is showing a descending chart pattern, a descending weekly trend, the intermediate trend line here as well. There are a number of factors that are pointing to lower prices. I just want to get rid of a certain obstacle that is currently there. Again, let me know, guys, does this make sense? Give us a quick yes or no, please, in that questions box. We'll finish off with the Dow. We're seeing a market here that's, in a strong uptrend at the moment. Indices have been for a couple of months now, ever since, pretty tough year actually. It wasn't. What was it? The S&Ps to the end of August down about 17% for the year. That's a pretty grim year, to be honest with you. It's been a little bit more stronger of late, notwithstanding sort of sideways move for the last month or so. But we do have a potential buying opportunity here. I quite like it. I don't see anything here that's, a real problem. Okay, you could say up to, the market's 34,387. There's a resistance level up there, and there is, but, it's not like it's a strong area of resistance for me. So I'm actually really relatively okay with this opportunity. And you're seeing a market that is still showing its ascendancy. It's got a positive weekly trend, a positive monthly trend. The momentum is starting to rotate higher as well, having had a correction. And you think about a correction, that's a relatively brief correction. Well, so is that one, and so is that one. You get a lot of these brief corrections if the market's in a correction phase, or a correction of a bull market phase, or correction of a bear market phase, or whether it's in a bull market. So that's nothing to be surprised about. And in fact, trading indices and stocks, the underlying stocks themselves, is far easier with the buying trades than it is on the short trades. Largely that's because the way in which a market falls is very different to the way in which a market rises with stocks and indices, and therefore indices. So I'm quite happy with this as an opportunity. We'll see where we go with it. The stop loss is the aggressive stop loss, as we call it, at that level. And yeah, there's probably not really too much really else to say. It's just a relatively clean looking example, particularly if we can look to close up at these highs as well. My only caveat to this really is to do with the economic data that's coming out later on this week. So we've got some major data that is coming out on Wednesday. So we're Tuesday today. We've got US interest rates that are coming out. That's going to be a pretty high impact piece of information. And we've also got inflation data, which is coming out in about 23 minutes. So it's going to be interesting to see what the impact of that is and whether it negates taking the opportunity in the first place. It might do, depending on what this data is. But certainly, I would think very carefully. This is one of the biggest data weeks of the year, actually, believe it or not, because we've got CPI, we've got inflation data in the States, we've got US interest rates, we've got UK interest rates, we've got goodness knows whatever else coming through. It's pretty much everything, really. We've got European interest rates and so on. So there's an awful lot that is going on here. So my view would be, I'm interested in taking it. All other things being equal, I'd be very keen on it. My problem is to do with interest rates tomorrow, which doesn't give very long for this opportunity to put a decent move in before we start thinking about interest rate announcements on Wednesday evening. So it could be a case, and certainly the more risk-averse traders out there, might be looking to close that trade off before the interest rate data is announced. So I feel like I'm getting the trade police in the way here, and I feel like I'm talking about lots of obstacles in today's trading. This is actually an unusual week with the data that we've got this week, and I think that we're still presenting lots of different opportunities that are out there. sometimes it's important just to have a look at some of these other little factors that can really help us to a much smoother equity curve. And that's really the goal here, isn't it? We want to be profitable, and really we want to be trading in such a way that our equity curve is as smooth as possible, so the growth of our account isn't terribly erratic. We just want a nice smooth ratcheting to the upside. Okay, so some of the things we've talked about today are all really with a view to having that starting point of those sniper discs, and then what can we do to help us give a little bit of extra color on that to help us to a smoother ride with our trading as well. Okay, hopefully that makes sense. Everyone, has this been useful today? Give us a quick yes or a no, please, in the questions box. I've been waffling on for about 40 minutes, believe it or not. It feels like it's been about 15 minutes, but hopefully there's been some good stuff in there. I'll probably stop now. I was going to talk about stocks, but I think I've really overrun as it is anyway. So, but hopefully this is kind of useful. Look, if you are trading already and you're not a Trendsignal member, it might be something you'd be interested in. We've got a number of different courses that we provide traders with that we'd love to teach you. We'd love to go through those strategies with you. So please do let me know. If you're interested, you can get in touch with us. There's a phone number there, and there's also our email address there. So if you're interested in our courses, just ping us a quick email or go to our website. You can have a look around, trend-signal.com, and so on, and we can teach you a little bit more about what we do here. Otherwise, yeah, I think that's probably it, really. Have a wonderful rest of the week's trading, and we'll see you next time. Oh, quick question from Damien. Are there any significant factors dealing with indices as opposed to Forex? I would say you just got to be aware. The thing about the indices is two things I'd probably say just off the top of my head. Number one, Damien, is that they move in points terms significantly faster. So that would mean that ordinarily you would need a smaller stake per point. So if you're spread betting, you would need to do a smaller trade size for the same sort of monetary risk. So a pound a point on pound against the dollar is a significantly slower and smaller move than a pound a point on the Dow. The other thing that I would say is, again, going back to what I said before, in a way, you could say that stocks are designed to go up, and perhaps they do have that long bias or upward bias over time. That doesn't necessarily help us as a trader, but there is an element really of that. But the way in which, like, why should the pound fall faster than the dollar would rise, or the dollar would fall? There is no real reason. The currencies will go up or down in a similar speed. Whereas with indices and stocks, they will typically fall much faster than they will rise, and that's because people are generally long stocks, right? If you're long the pound, it means you short the dollar. If you're short the dollar, it means you're long the pound, and vice versa. I said the same thing the other way around, but you see what I mean. When it comes to stocks, people are predominantly long stocks, right? So you own stocks, and what that means is that you will are more likely to panic out of a trade than you are to panic into a long position. So what generally happens is that the speed in which a stock falls or an index falls is typically faster than the speed in which a stock or an index rises. Now, you would think there's a similar relationship with cryptocurrencies, but because of the lack of volume in cryptocurrencies, it actually can go up extremely fast as well. So you get big volatility either way. But you definitely get that panic factor with stocks, where the stocks can move down very quickly. It's up by the stairs, down by the escalator is the expression. The other thing, and what that means is that there is a danger in short selling, in that when you're short selling stocks, the problem you can have with it is that you think the market's going to have a correction, but it could actually do it all in the first day or two. So that by the time you notice a correction has started, it's probably already happened, which means that if you're entering too many short trades on indices, it's probably already had its major correction, which means you're about to sell on the lows, which can be an extremely difficult situation. Yeah, do you see what I mean? So otherwise, they're broadly the same. But I just think that there is because of the way in which they fall and rise differently, it can be could be quite important. The other thing with indices is as well, there are I believe, much stronger sort of sentiment gauges as well. So you can use things like, retail sentiment gauges, or you can use things like the VIX, to get a real measure of how far, when this market's really overstretched, particularly to the downside. But we can talk about those in other events as well. Okay, Emmanuel, a good couple of questions there. What is the least amount of cash to start with, though I'm in full-time job? It's kind of up to you. A lot of brokers can allow you to trade pretty small size these days, Emmanuel. So the good thing is to trade in a way that you're relaxed about. So I would say realistically, though, something like maybe £500 into an account, $500, that sort of thing, that can allow you to trade in a sort of the smallest bit possible. The thing to do with it, even if you've got more capital for later on, is that you want to get it right first, prove to yourself that you can do this first, and then you can always add capital to your account later on. There's no point wading in with 100 grand anyway, even if you've got it, you're fortunate enough to have it. Because when you're new to something, you're more likely to make one or two mistakes anyway, right? So you may as well make small mistakes than big ones and expensive ones. So something like that, I think, is probably about the right sort of play. The problem you've got, if you start too small, what you're going to have to do is trade perhaps a really small size that your broker won't even allow it, maybe, or you'll have to put your stop loss super tight, that because you don't want to risk too much, and then your stop loss won't be wide enough to allow the trade to run its natural course, so you'll end up getting stopped out. You'll end up getting sort of defeating the purpose of it a little bit, but hopefully that's okay. And is it possible to trade 30 minutes twice a week? It's okay, but you're probably better off looking at something more like a weekly type of opportunity, or being holding positions for a few more days. What you want, if you only look at the markets a couple of times a week for 30 minutes, you either want to be probably sort of scalping for those 30 minutes, just quickly in and out, or you're going to be looking at holding trades for maybe a 2 or 3 week sort of duration, probably. Or you trade off a daily chart, but just accept the fact that you're going to miss a few trades, but that's okay. I don't think anyone should have a really problem with that. You just accept the way and the time that you have, and that's fine. And as you become more experienced, you start getting better results. Of course, you could look to allocate more time to it from there. GoGo, is the TradeMate app available to download for non-members? No, it is exclusive to our members. GoGo. But if something you want to talk about, and if you want to find out about costs of our programs and things like that, then just get in touch with the details on screen. Okay, good. I'm going to call it an end to the session now, but thanks for being in today's. Hopefully that was enjoyable and useful. And like I said, have a great week's trading, and we'll catch you. We'll be online again, I think, next Tuesday. So we'll see you then. Bye-bye.